Okay. I've started the Twitter Spaces. Hopefully, I just see Max there right now, but the purpose of Twitter Spaces is to extend the reach of this learning group. So if people on Twitter happen to come across this learning group, they can hop in and get to the visuals from this presentation on the open Discord. So periodically I'll remind people that the link to the open Discord is tiny.cc/open Discord. But I figure like right now we can get into the learning group. I'll give you guys kind of like an overview of the agenda right now, and then introduce Greg, and then we'll let Greg dive into it. But in terms of what to expect, I'll start with this introduction and intro Greg, and then we'll get into sort of like options volatility. And Greg's got a presentation to go over volatility in depth. And for anyone listening either on Twitter, please come to Discord. It's tiny.cc/open Discord to see the presentation. And for those of you that are already in Discord, if you have questions at any point during this learning group, feel free to jump in and ask Greg, because I know a lot of this stuff like might be technical for first-time learners. But without further ado, Greg joins us from Genesis Volatility. He is a founder of GVol, and I will let him talk about his background, how he got into options. But I will say, like, Greg's one of the like most fun people in DeFi to work with and get to know. Genesis has built a bunch of like options analytics for OPYN that are on the OPYN options chain. So Greg, I'll hand it over to you, but I know everyone here will be as interested to hear about your background as I was when I first met you.
Cool. Thanks, Wade. What's up, everyone? Super happy to be here. So my background is a trading background. I've been trading for about 11 years. I was a prop trader out of Chicago. I traded at Sharper Trading and DRW Trading. I got into crypto, first invested in crypto in around 2013. And I first discovered crypto and did research in the crypto space in June of 2012. Me and actually Linda Shea did a research paper at UC San Diego about the crypto space, went on the dark web to explore what that was all about and kind of learn about crypto at that point. My first love is options. I'm completely obsessed with options. And my second love is crypto. So that's kind of my order of operations. And ever since I've discovered crypto options, I was super jazzed about it. And we launched Genesis Volatility, me and my co-founder, Pat Doyle, back in January of 2020. So today I'm going to explain pretty much the underlying fundamentals of derivatives trading, which is the volatility space, why people trade volatility, how to look at the space, and how to find actionable trading signals and strategies. So if anyone has questions along the way, feel free to let me know, and then I'll pretty much take it from there. So sort of jumping into it, the first question is why trade volatility? So the main attraction to volatility trading is that it's mean reverting. So if you're trading spot, it's very tempting to sort of buy the dip or sell the new all-time high, thinking like, things will come back the way that they did. In the spot market, this is not necessarily true, and things can really keep going. We saw, for example, last year, people buying 1 penny oil to see oil go negative $40. So in the spot market, there's sort of no reason for things to ever mean revert. In the volatility space, that is not true. In the volatility space, things mean revert over time. So periods of high volatility tend to go back to the median, and periods of low volatility tend to go back to the median. So the next question is, well, what is volatility? So many of you who have taken statistics classes know what standard deviations are. And basically, when people are talking about volatility, they're talking about the standard deviation of the returns. So basically, you calculate the returns day over day, for example, So let's say you see, it went up 2% today, then went up 3% the next day, then went down 4%, so on and so forth. Well, you can calculate the standard deviation of those percentage returns, and that is going to be your volatility value. One quick note on that: you have to use compounded returns, not simple returns, but that is the general gist of it. So when I'm looking at volatility trades, the first thing I really like to do is look at the underlying volatility of the asset using a volatility cone. So right now we're looking at a Bitcoin volatility cone for the past 1 year. And what this is telling us is whether we're looking at 1 day volatility or 7-day volatility or 14 or 30 day or 90, so on and so forth, we can see over the past year what has been the maximum here in pink, what has been the minimum realized volatility here in pink, the median here in white, and then the upper 75th percentile and the lower 25th percentile. And in blue, we can see where we currently reside in that context. So the really good thing about this is it tells you what kind of range does volatility take, where are we in that range right now, and where can we expect the median or the true sort of central tendency to be. So this is kind of the first step that I like to do when I'm looking at the volatility space. The second sort of interesting thing to look at is how does realized volatility move? So realized volatility can move with spot prices, or can move versus spot prices. So if we're looking at the past 1 year of data, so this is the past 1 year of Bitcoin prices, we can see that Bitcoin's gone from about 10,000 all the way up to a little over 60, back down to 30, and then now back at 50. So how does that look like in the volatility space? So let me just explain this chart a little bit. Here we're using hourly data. So we're calculating the standard deviation, which is later annualized using hourly data. So 20 hours is going to be 30 days, and 240 hours is going to be 10 days. So right now I'm looking at the relationship of 10-day vol and 30-day vol. Now, something that's interesting to note when you're looking at these relationships is you'll see like this blue line, which is 10-day vol, have very sharp spikes and come back down. So you can think of it as a large crash in prices that kind of stabilizes out. But if you're looking at 30-day vol, this 10-day window hasn't really dropped out of the 30-day calculation. So you can see that 30-day vol remains high and later drops out once this sort of 10-day sample is excluded from the calculation. So just with the nature of mean reversion, if you have a large calculation sample that includes these outliers, until those outliers drop out of the sample, your longer dated calculation methods are going to be skewed towards those outliers. So that's just something to look at, keep in mind. And the other thing to look at is correlation. So we can see that spot prices have rallied all the way up to pretty much May. And during that spot price rally, we had an increase in volatility. So we were seeing increased prices with increased realized volatility. After that, around, call it Feb to late April, we had a sort of a plateauing of spot prices, and we could see that volatility was decreasing again. Then in mid-May, we had a huge sell-off, and we sort of had this nice inverse correlation between spot prices and volatility. So the May sell-off was really sharp, made volatility screaming higher, and now we have volatility coming in on negative prices. And then finally, we're having this nice recovery rally, and the volatility market is being subdued going forward. So prices are rallying and volatility is coming back out of the market. So this is really important to consider, because when you're trading calls or puts, you're not only making a bet on direction, but you can structure your trades to make bets on volatility as well. So for example, when the volatility space was really cheap and the past history had the correlation to spot being positive, that creates a potential environment where people sort of forget about puts, become less interested in puts, and the value of puts becomes really cheap. And all of a sudden you have sort of this surprise move. And not only does spot go down, making puts more expensive, but volatility goes up at the same time. And all of a sudden, put trading has become really profitable. Vice versa on the other side of things. I'll just take a quick check here. If anyone has questions, happy to answer anything. Otherwise, I'll keep going. Okay, cool. So the next relationship to look at is going to be the relationship between implied volatility and realized volatility. So let me just give you guys a quick note on implied and realized. So realized is what we've been talking about so far, and that is what is the actual underlying asset, in this case, Bitcoin, doing? Like, how is it moving? How is it, how are the returns day to day? What is the standard deviation of returns, so on and so forth. So that's the realized volatility. That's actually the volatility of the underlying asset. And then the implied volatility is going to be, how is the option market pricing the volatility of Bitcoin? So here we have a chart depicting the relationship between realized volatility and implied volatility. So the implied volatility is going to be this pink line, and this is going to be the actual traded implied volatility. And the realized volatility is going to be this blue line. And this is going to be the actual volatility of Bitcoin itself. So let me just kind of give some context around this pink line. So right now I'm looking at actual trade data. I filtered this down. I'm looking at everything that has a delta range between 0.4 and 0.6. So that's going to be around at the money calls. I'm looking for options that have 0 to 32 or 0 to 30 days till expiration. Call it 15 days. And then I have a realized vol window of 15. And now we can see, okay, how did 15-day realized vol trade with about 15-day implied vol for at the money Bitcoin call options? And something you'll see here is that because volatility is mean reverting, you'll have periods where realized volatility is high and the implied volatility is trading below realized, and other periods where the realized volatility is low, like right now, and implied volatility is trading above the realized. So the reason why that relationship exists is because people are sort of betting or positioning themselves to expect realized volatility to mean revert. So in this case, today, people are expecting realized volatility to increase going forward in the future. But back in May, people were expecting realized volatility to decrease going out into the future. So that relationship between implied and realized volatility is something called the variance premium. So in general, I mean, there's been studies done about this, for example, between S&P 500 options and the S&P 500 realized volatility. And for the S&P 500, typically options are overpriced by about 4 implied volatility points. So what that tells you is that in the long run, people usually overprice options, just like a normal insurance company sells insurance at a higher premium than the payouts that they expect to make. And the reason why that is a couple things. One is a profitable business needs a profit margin. But the other aspect is that people who are selling options are also pricing in unknown events that have never happened before. So right now we're looking at historical realized volatility. This is a set of realized volatility that has happened in the past. But who's to say that, for example, people find collisions in SHA-256 or whatever the security mechanism for the blockchain is, and all of a sudden the crypto space drops 90% overnight. So that's sort of an unknown unknown, or I guess that's a known unknown, and there's plenty of unknown unknowns. So as an options trader, you got to keep that in mind when you're selling options, and therefore selling exactly at realized volatility is typically not going to be profitable. You need to have some sort of buffer there in that profit margin. So again, just recap, the relationship between realized and implied is going to be called the variance premium. Just gonna take a quick second here, see if anyone has questions. Cool. All right. So the next thing to kind of think about is the volatility surface. So now we're going to go, we started with realized, we've gone to the realized versus implied relationship, and now we're going to go straight to the implied volatility space. So when we're looking at the implied volatility space, there's a few things to consider. So the first thing we have here is the option skews. So this is going to tell us how are options priced? How's implied volatility priced for options with different strike prices? So assuming I'm only looking at, call it the December 31st expiration, and right now Bitcoin's around 50,000. So at the money volatility is around 93. But why is $90,000 calls priced at 98 vol, or $160,000 calls priced at 110 vol, so on and so forth? So I'm going to take a quick deviation here. I'm just going to explain something briefly. And this is the assumption of normal distributions. So when we're looking at implied volatility, most people quote it in terms of the Black-Scholes formula. And the Black-Scholes formula assumes normally distributed prices. Now, the question I get all the time is, well, if underlying assets are not normally distributed, why do we look at the Black-Scholes formula? Isn't that the incorrect formula? And so there's an argument to be made that if you can figure out the perfect pricing formula that would perfectly model how the underlying moves, then yeah, you could have a perfect option pricing formula, and you would probably have a flat skew structure, so on and so forth. There'd probably be one implied volatility across all strikes. The problem with that thinking is twofold. One is that price distributions are not static. So even if you could basically data mine and sample fit the price distribution of the past and get the perfect pricing formula from there, who's to say that the distribution of asset prices are going to remain the same going forward? So because of that, because they're dynamic distributions, your pricing formula for the past isn't guaranteed to work in the future. So that's the first problem. The second problem, or this is not a problem, but it's more of a way of going about things, is that using the Black-Scholes formula is very well understood. And most traders understand that the Black-Scholes formula has the shortcoming of normally distributed prices. And therefore, the shortcomings are well understood. Everyone's on the same page. And so using one sort of standard reference formula to look at everything keeps pretty much all traders talking the same language. If everyone has a bespoke pricing formula, your 110 volatility says nothing to my 123 volatility versus the other person's 117 volatility versus the other person's 150% volatility, because the assumptions would have to be explained all the time. If everyone knows the same model and referring to the same thing, the shortcomings are well understood and everyone's speaking the same language. Happy to just take a quick pause, see if there's any questions here. Okay, cool. So looking at kurtosis, so typically asset prices have more kurtosis than normally distributed asset prices. So what does that mean? So that means that the tails, here in blue, you can see the tails are fatter, which means 3 standard deviation moves, 4 standard deviation moves, 6, 7, 8, 9, 10 standard deviation moves happen with a higher frequency than the normal distribution would imply. On the flip side, smaller moves, like the moves that are within, call it a quarter standard deviation, happen at a much higher frequency than the normal distribution would imply. So you could see this peakness up here happens way more, and then the tails over here happen way more. What doesn't happen as often is sort of the 1 to 2 standard deviation levels. So what that says is that if you're using the Black-Scholes pricing formula on price distribution with high kurtosis. Basically, most of the time options are overpriced, and when they're not overpriced, they're drastically underpriced. So the mid-range almost never happens, and therefore the options using the normal distribution will overstate this frequency, understate these two frequencies. So how do people adjust for this? Well, you get option skews. So the way to think about this, jumping back to our example here of the 1231 expiration, is that people are pricing this $160,000 strike with a 110% volatility versus the at the money of 93% volatility. That 17-point differential is pricing in that, hey, when Bitcoin does move, it can get to 160. It's going to do so with a lot more volatility than if Bitcoin is just chilling here and we're having the regular day-to-day volatility. So in order to compensate for the non-normally distributed prices, option sellers require higher premium for these way out of the money tails to compensate for the non-normal distribution. So that is kind of the first slice of the vol surface. Then there's the second slice, which is the term structure. So the term structure is going to tell us, well, how is volatility priced in terms of different expirations? So again, volatility is mean reverting. So just because volatility is low today, if it's below the mean, in the long run, it's going to go back up to, or I should say below the median, in the long run, it's going to go back up to the median. And if volatility is higher today, in the long run, it's going to go back down to the median. So one good way to sort of explore this concept is we can go to historical activity and we can compare this term structure for different periods. So right now, we have the current term structure here in pink, but let's go ahead and look at, call it May 20th at 3 p.m. UTC. Okay, so May 20th, we had a huge sell-off in Bitcoin, or we're just coming off of a huge sell-off in Bitcoin, and the vol space was pretty high. So you had sort of this flat term structure, and I bet if I just change the time, we'd have a backwardated term structure. Okay, cool. So here we have a backwardated term structure. This is in the heat of spot price sell-off. People are, wait, do you mind just muting this guy?
Yep.
Cool. All right. Let's see here. Okay, so we're having a huge sell-off here. People are buying puts for protection. That's causing implied volatility to go up, but prices are selling off right now. In the future, the volatility is going to mean revert, and so you get this backwardated curve, meaning that over time, the longer your expiration, the more you're paying near the median. Now, today's context is very different. Today's context is, hey, we have low volatility, and over time, we expect to rise back towards the median. And so this relationship of the term structure provides a lot of opportunity. What you can do is, trade relative option values of short-term versus long-term, and you have to weight those options appropriately in terms of vega. So for example, longer dated options have more vega or volatility exposure than short dated options. So if you're doing a volatility trade, you want to weight them appropriately to offset the vegas. But this is just kind of a context of looking at this implied volatility term structure. So happy to answer some questions here if anyone has questions. Cool. All right. So the next thing is I'm going to dig into these tools to look at volatility calculator tools. And I just want to run through this particularly interesting concept. So let's say we're looking at Ether and call it at Ether is $3,000. And we're looking at, call it a $3,000 strike price. And let's say that the volatility is 75. And let's say there's 365 days. Okay, so what I'm doing here is I'm plugging in inputs to calculate the value of a call option. So this call has 365 days until expiration. The implied volatility is 75 points. The underlying price is 3,000. The strike price is 3,000. So this is an at-the-money call with 1 year until expiration, 75% vol. This option costs $877. Let's see what happens if we double vol to 150. If we double vol to 150, this option goes to $1,640. So it gains 100%. So here's something interesting. What if we change the strike price, do the same exercise, but change the strike price to 10,000? So now we're looking at a way out of the money call option. Ether has to rally 330% just to get at the money. And so right now, this call would be worth $89 if the volatility was 75%. But if we increase volatility to 150, remember in the last example that doubled the value. In this case, it's going to 10x the value. So why does a $10,000 call 10x when you double the volatility from 75 to 150, whereas an at-the-money call only 2x's in value? This concept is called lambda. It's a sort of a second derivative Greek in the option space. I'm just going to explain this, kind of explain it via the distributions. If you look at something that is normally distributed, the chances of being within 2 standard deviation encompasses about 95% of the probability space. Something being within 3 standard deviations encompasses something like 99.7% of the probability space. So the chances of being more than 3 standard deviations away is basically 1 in 300. So if we're looking at way out of the money options, we're looking at sort of this tail range. But if we increase the distribution surface, something that's way out of the money quickly jumps from 3 standard deviations out of the money to 2 standard deviations out of the money. And so what that means is that the probability of hitting, in this case, going from 3 to 2 standard deviations, jumps from 1 in 300 to 1 in 20. And all of a sudden, your option's worth a lot more because the probability of it hitting is a lot higher. If you're looking at the money, for example, your volatility surface, your distribution surface expanding or contracting has very little effect on it being in the money at expiration, because if it's at the money, it's still sort of a coin flip. It only affects how much in the money or out of the money your option will be at expiration. And so therefore, the lambda of an out of the money option, which is the percentage return of the option with respect to Vega, is going to be so much higher versus the percentage return of an at the money option with respect to Vega. So that's just kind of something that's really interesting. And when you're thinking about trading strategies, well, how do you use sort of this concept? So going back to where we are right now in today's context, let me just go back to realized volatility. Right now we have realized volatility that's dropping and prices that are increasing. And so the way that you can think about it is that selling some out of the money options and buying some at the money options, call it a 1x2 structure, can be really profitable because you're long that one option that's near the money. And as volatility goes down, the 2 short calls that you sold, for example, those will decay a lot faster and pretty much finance your call that's at the money. So that's a type of trading strategy that could be useful looking at the realized vol space and the implied vol space. Something else that you can do is just look at simple call writing and yield enhancement strategies. So this is really where I think OPYN and Ribbon really accelerate. And that's allowing traders to maximize yield on their assets. So for example, we can see the annualized yield of Bitcoin, or let's go to Ether, for example, the annualized yield of Ether call selling strategies. So for example, if I'm going to go to December 31st, end of the year, and I want to sell a $5,000 call on Ethereum, well, buying Ethereum today and selling a $5,000 call nets me a 45% annualized return. So it's true that you're capping off your gains at 5 Gs, but in exchange, you're getting a yield of 45% or 46% for that trade-off. And these types of strategies are pretty low risk. If you're sitting on coin, selling paper against that coin is pretty low risk. It's actually just a de-risking strategy. So those are kind of really cool trades that people newer to options can do to capitalize on the volatility space. Something else to kind of keep in mind is that crypto volatility is so much higher than equity volatility. So for example, implied volatility on the S&P 500 is around, call it 17 or 18%. And for example, equity volatility, crypto or ETH volatility is 96, 100, 112, much higher. So selling options has a larger premium associated with it for the crypto space, and that can be super useful for yield enhancement strategies. Cool. Does anyone have questions at this point? Alrighty.
No questions, but this is like very, very helpful, Greg. And again, like anybody in the audience, like don't be afraid to ask any questions. I know sometimes like a lot of the more technical option stuff can be intimidating, but I think like obviously the more you know, the better equipped you are to like manage certain market conditions. So Greg, this is really, really helpful.
Awesome. Happy to hear it. Okay, perfect. So next thing, I'll sort of jump into the DeFi tools that we've just launched. So we are pretty excited to start covering DeFi a lot more robustly. This is sort of our first attempt to cover OPYN, and we're really excited with what's going on. We're excited with all the volumes going through OPYN right now. So something to look at is sort of the open interest. The open interest for the open options in terms of calls versus puts, the different expirations, the different strike prices. Something else we'd like to look at is the volume. So for example, the past 24-hour volume that was executed through the 0x protocol was really dominated on the put side. So there's about 78 puts that have been sold, all in the August 27th expiration. So this Friday's expiration, concentrated at the $27,000 $2,700 strike price. So it looks like people were selling puts at $2,700. So we can go ahead and look at that. We can see, maybe 24. Let's see. We can go ahead and see like where the concentration of data is. Here we go. Cool. So we can see, okay, what's the total open interest? We can see the total open interest is around 900 O tokens. We can see the distribution of which wallets have the most, are responsible for most of this open interest. And then if we scroll down some more, we can sort of see the top trades that have occurred today and where that implied vol is trading. So if I order this by O token amount, I could see, oh, okay, so people are buying the puts. So in this case, people were buying these $2,700 puts. And there's about 45 O tokens that traded here for about $350 of premium. I can go ahead and click this transaction, and I can see where the volatility traded versus where Deribit was at the time. So someone traded 130 vol for this, 129, 134. And at the time, Deribit was about 109. So this is like really interesting if you're a seller on this side of the trade. So having some open order book orders there, hoping to sell against someone who wants to buy something on chain, there's some volatility edge there to be had. Now, if anyone's ever considering, okay, what does 129% vol versus 110% vol translate to in dollars? Well, the formula there is really easy. What we do is we look at the vega of this option. So we could see the vega of this option. I'd have to calculate it, but let's call it 50 cents per point. Well, there's 20-point difference. So therefore, we know that each option is $10 overpriced in this case. And so basically, volatility points times vega is going to be your differential. And that's going to be your edge if you're doing a strategy like this. So that's something that's really interesting, and we're really excited about everything that's going on in the space. And that's pretty much it. So I'm happy to answer any questions and take it from there.
Hi. Well, first of all, thank you, Greg. That's super helpful. I wonder, I'm pretty new to options, so I wonder if everything just said was a document somewhere, so I can go review it after the call. Thank you.
Cool. Thanks for the question. So we do have a YouTube channel. I'm happy to share it. Let's see here. If you just go to YouTube and you type in GVol, you'll see basically a lot of our instructional videos. And you can see pretty much a lot of the explanations of realized volatility, option Greeks, the vol surface, stuff like that. So that's kind of a good resource that we have out there. So it's just GVol in your YouTube search bar, and that's a good place to start. Otherwise, within our web app, there are explanation bubbles. So we have the calculation bubble here that pretty much explains how things are calculated. But we also have the question mark bubble, which will tell you why a trader would find this useful, how to think about sort of this chart and these curves and stuff like that.
Thank you.
Hey, Greg, question for you.
Yep.
Hey, so love your platform. I'm wondering, do you guys actually manage your own book with regards to any of these products?
We do not.
Okay, cool. Thanks. Yeah, it's really interesting with what you said about that, those calls being 45 to 50% yield.
Yeah, absolutely. We think that's a really interesting opportunity, and especially people who are sitting on coin, might as well enhance yield.
Great. Thank you very much.
You're welcome.
Hey, Greg, double clicking on that. Is there a calculator in the Genesis volatility tool where you can plug in like how much, let's say, ETH you have, and then like look at strike prices and expiration dates based on like how much yield you will generate if that option expires out of the money, and the like likelihood that that particular option will expire out of the money based on like spot price and IV?
So this is a great question. You can get that. So let me just show you real quick. It's not all in one place, but it's the tools are here to calculate that. So for example, likelihood, again, assuming normal distributions, but let's say we're looking at 90 vol. Here we have pretty much the standard deviations or the probability cone, which tells you the standard deviations of Bitcoin given different time frames. So you can see right now Bitcoin's at 48,175, and so the probability of it being below 28,000 or above 80,000 by September 23rd is going to be two standard deviations out. So there's a 95% chance that we're within that band. If you go to the calculator tool, there's another way to do it as well, where you can type in your volatility assumptions, the projected price, Bitcoin, and the expiration date. So let's say going to the end of the year, what's the probability that Bitcoin is going to be at $100,000, assuming, call it 81% volatility. So the probability is going to be 6.55%. So that's kind of your first part of the question. And then the second part of the question is the projected yield. So we call this a call out yield. So basically, if I go to the annualized call out yield and I'm selling the $100,000 strike by the end of the year, if we actually got there, my annualized return is 335%. And again, the probability of getting there is 6.55%.
That's really helpful. Thank you.
You're welcome.
Hey, Greg, a couple of questions. First, do you guys expose an API to the users to pull this data?
So we do have an API solution. It's a $800 a month subscription. We don't have a free API.
Okay, got it. And then in terms of the DeFi timeline, I guess one really broad question and then one more specific one. So like, what do you see as largely like what's holding back kind of option scaling within DeFi beyond like the Ethereum L1 concerns? And then kind of like, do you plan on integrating that into the platform come couple of months or whenever?
Yeah, we actually think that fragmentation is sort of the biggest like holdback. So like people don't necessarily know where to go for all the different protocols and how to like where to execute different things. So we actually hope that incorporating various DeFi option protocols into our platform will be a nice place for people to compare prices and basically route to the protocol where they find the most edge. So I think that fragmentation is the first step. And then from our standpoint, we are planning to spin up our own Ethereum node and maintain that internally. And basically at that point, it'll be a lot easier for us to get up and running with more detailed and more holistic coverage of the DeFi option space.
Greg,
Yes.
I was wondering, what size of portfolio would you recommend someone to start an option crypto?
So this is a really good question. The way that I think about it is that I think the first aspect is to understand what kind of trader or what kind of book are you trying to run. If you're trying to run a market making book, where basically you have to post a lot of collateral to be both on the short side and the long side of options, to have basically quotes going across all the ladders on the screens all the time, you're probably not going to be able to do that short of a couple $1 million. If you're just sort of a retail trader and you want to enhance yield on your position, I mean, you could do it with a fraction of an ETH or a fraction of a Bitcoin.
Thank you.
You're welcome. Cool. Well, unless there's any more questions, Wade, I'll hand it back over to you.
Yeah, Greg, this is been my favorite learning group. I know I learned a lot in this. So I appreciate you taking so much time out of your day to go over this. For everybody listening, there will be a recording of this I'll send this video to Greg to put on the Genesis Volatility YouTube group, and I'll also share a copy on the OPYN YouTube channel as well. But I guess I'll ask the audience if there's any more questions, but if not, we'll wrap this up. But again, Greg, this has been super informative. So thank you so much for going through everything. And also showcasing the GVol analytics platform. I know I hadn't seen some of these features before, and this looks like by far the most robust and powerful tool to get options analytics, not only in DeFi, but kind of comparing CeFi as well.
Thanks a lot, Wade.
So does anybody have any questions? I'll pause